split. Good morning, everybody. Thanks for joining us for our monthly speaker series. We have a great speaker lined up for you today. He's going to cover everything 1031 exchange. Before we get to Anthony, I'd like to just take a minute to introduce our Heritage Escrow team. I'm John Curry. I'm the sales executive out of our Balboa Park office. I represent two great escrow officers in Debbie Howe and Donna Hamilton. I'll pass to Bree so she can run through her team.
Morning, everyone. My name is Brianna Nadeau, and I'm the Carlsbad sales executive. I support three escrow officers, Anela Miashirlindo, Holly Burt, and Rana Del Rosario. Before I hand it off to John, I just did want to tell everyone that this is being recorded, and the team will be sending out this recording link and presentation after the webinar.
Cool. And then we are missing one person that we usually have on our team. We have Jarrah Payne, who's on vacation today. She's in Sedona. I'm sure she's really enjoying herself out there right now, but she has two escrow officers, and Stephanie Clark and Kristen Bramble in our Rancho Santa Fe office. So without wasting any more time, let's get to Anthony Alosi. He is the Senior VP of First American Exchange Company and has been with them since 1999, managing all of West Coast operations. So basically, he knows what he's talking about when it comes to things like 1031 exchange related. So Anthony, do your thing.
Okay, thanks. Good morning, everybody. And thank you for the intro, John. I'll add just as a shameless plug here, before my exchange stint, I was an escrow officer as well with First American. So I know both sides of the escrow and exchange side fairly well. So thank you again for having me. I'm excited to talk to you guys today about the exchange process, how it works. I'm sure you see it every single day. We're going to give you some background today that hopefully helps you understand the mechanics of the exchange and the process in which it happens and all the magic that happens here on our end after you guys close your escrow. So number one, first off and foremost, thank you guys for the referrals you send to First American Exchange. We do appreciate that. To us, our affiliates and our sister company are our biggest customers by far, and we want to make sure that we continue to service them correctly and take care of them. And as you'll see in the later on in our presentation, not all exchange companies are created equally, and we definitely have an advantage over some of the smaller independent exchange companies. So we'll talk about that as well too. I'll start by saying the presentation you're going to see today is generally something I give to investors, real estate agents, CPAs, attorneys, what have you. Some of it's a little basic, but sometimes people say, oh, I know enough about 1031s to be dangerous. I know just a little bit. So we're going to kind of cover the highlights of the exchange process and how it works. I told John, I said, I like it to be very interactive. If you have questions, I understand you can raise your hand or ask a question that way, and we'll try to address it as we go. But we talk about an exchange. I want people to understand it's specifically designed for investors. When we talk about 1031, I get it out of the way up front. We're eliminating any discussion today about the client's personal residence or primary residence, right? An exchange is simply not that. An exchange is something that is held for investment. So on residential transactions, we see a lot of rental property, income-producing property, duplexes, triplexes, fourplex. On non-residential transactions, we see any and all different property types. Commercial, industrial, retail, office buildings, raw land. Anything that is not used as their primary residence potentially can be an exchange transaction. And the good thing about 1031 is, number one, it is an exchange. You're selling something and you're buying something. So in that transaction, you always have at least two escrows involved. The relinquished property, which is the sale or the disposition, the replacement property, which is the acquisition. So you have to have an exchange in order for this to work. 1031 does fall under IRS section code 1031. It is federal, so we know we're not limited to the state of California, which is good. Investors can come in and out of different states, move their money to different locations, different property types, which we'll cover as well too. So they do have a lot of flexibility within the code section to move about the country and chase a better investment if they need to. The other great thing about an exchange is there's no minimum and there's no maximum amount you can defer at this point, right? With your, real quickly on your primary residence, you get an exemption from capital gains tax or an exclusion. You can exclude $250,000 if you're a single person and $500,000 if you're a married couple filing a joint tax return. You can exclude that much of gain from the property. And remember, gain is different than equity, right? Gain is something that you have in terms of appreciation. I bought the house for $500,000. It's worth $1 million today. I've got $500,000 of gain. Maybe they refinanced it last year and they have very little equity. That doesn't impact their gain. So I always tell people, remember, gain and basis are totally different than equity and debt. Someone could have a property that has a lot of equity and very little gain, or the opposite. A property that has very little equity, but has a ton of gain because they've owned it for years and years and years, and they've recently refinanced the transaction. So let's go on to the next slide, Brianna.
Sorry, let me.
Okay.
There you go.
Okay, so why do people do an exchange? I like to think in my world, they do it because they want to, use a qualified intermediary, and they talk about capital gains deferral and all that. Generally, no, that's not their primary focus. We talk about why people exchange is because they're looking to better their investment, right? A lot of times they want to increase their cash flow. They want to move out of state, chase a better investment. They want to, increase their overall net worth. They want to continue to leverage themselves as much as possible. The icing on the cake is the 1031 process. And believe it or not, it's 2022, and we still have people say, I've never heard about this before. I've never done an exchange. My first one, no one's told me about this before. And I kind of scratch my head and go, who's your tax advisor? Who's your CPA? Why are you not getting this information? Even a real estate agent should be, introducing the client to an exchange, especially if they know the property that is being sold is, let's say, non-owner occupied, a rental property, a duplex, something like that. So for us, when we get to the customer, and we really are maybe the third or fourth person the customer talks to. Rarely are we the first, right? They've talked to their real estate agent, they've talked to their CPA potentially, they've talked to you guys as their escrow officer or their escrow assistant. So by the time they get to me, they've already talked to a few people, and they have some misunderstandings or they have some questions about the exchange process. For us, the benefit is they're twofold. Today, they get the immediate benefit of a deferral of capital gains tax. And for your, typical California investor, that's a big number these days, right? Federal capital gains tax can be up to 20%. The state of California is 13.3. We still have the Obamacare tax that's in place at 3.8. Plus, we also have another component, which is called depreciation or recapture. And they pay the amount of depreciation they've taken on the property up to 25%. So for a tip, and a lot of this is based on incomes. If they meet the maximum threshold on income, then they're going to meet the maximums for the federal and state and the Obamacare. But let's say a lot of the people in the exchange world do meet that requirement. Their capital gains tax could be in essence of 35%, which again is a big number on property that's being sold where let's just say there's $1 million of gain. Well, $350,000+ goes to pay capital gains tax. I mean, again, a big number. So for us, 1031s have become widely popular. I'm sure you see a lot of them in your escrows today. We have done we've seen a dramatic increase in the amount of transactions since COVID, believe it or not. COVID was a tiny blip on the radar for us, right? March, April of 2020, things were, kind of slow, maybe a little scary. All of a sudden, since then, the market has gone like that, and people have been exchanging hand over fist. We see transactions coming out everywhere. For us, we can work on an exchange anywhere in the US, right? We're not just tied to local California or Southern California transactions. We can do an exchange for anybody anywhere in the US. So that's good news. So again, what the component that gets overlooked a lot of times, and now again, these are discussions that you're probably not going to have with your customer about the exchange process. Really more of it is kind of for your information and just so you get some knowledge and background about the exchange process. But the real benefit of an exchange, the customer doesn't even see it, right? They get this, what we call a step up in basis once they pass. So the old adage for 1031 is defer, 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 then die. At your death, your heirs or your estate receives what we call a step up in basis. So the capital gains tax for mom and dad, for whoever, it gets relieved upon their death. So I always give the example, let's say, my parents started their real estate, their real estate process in 2001. They deferred a few times. They've done 3 or 4 exchanges, and now it's 2025, and they both have passed. And they now have a real estate portfolio worth $4 million, right? It's 6 properties, and the total value is $4 million. And they've done 4 exchanges, and they've deferred $3.5 million of gain. They've been very good, very savvy real estate investors. And now I'm the sole heir, and I'm now entitled to receive these 6 properties. I receive the 6 properties at a new stepped up basis. My basis in the property is current market value, $6 million. The gain that they have, gone, gets relieved. I inherit the properties at $4 million. I can do one of 2 things. I can sell the properties. I can put $4 million in my pocket, walk away, have no requirement to reinvest it. or I can continue to hold the properties, manage them, collect the income, and now my basis will adjust, but at that $4 million, level. So really for an exchange, there's a two-pronged benefit, right? The benefit is today, they get the benefit of capital gains tax deferral. The bigger benefit comes to them down the road when they pass or expire. So we keep telling people, look, remember an exchange is it's a long-term play. Keep exchanging. You're not going to reach a point in your life where Uncle Sam says, hey, John, guess what? You made it to 95. Congratulations. You're now free of any capital gains tax. You can go ahead and liquidate. You can go to your boat in Newport and ride off into the sunset. Not going to happen. That capital gains tax gets deferred for them indefinitely until they either sell or they expire. Once they sell, they're subject to the capital gains tax. Once they pass, they get the step-up basis and the properties get inherited at current market value. So let me pause real quick. I don't know if we have any questions in the chat, Brianna.
Yep, we got one in there for you. The question is, if the replacement property is a fourplex and I rent out 3 units and live in one, does that qualify?
Yeah, I don't see why not. So that would be something I would call like mixed use property, right? So again, and the beauty of that is, let's say, again, just for round numbers, the fourplex is worth $1 million and all the units are equal. You can take your $250,000 exemption out for your primary residence and then do an exchange for $750,000. So you can take the $250,000, put in your pocket, and just exchange the balance of the 3 units into something else. And remember, with your primary residence, it's an exclusion, right? There's no requirement to reinvest, right? You take the capital gains tax, you put in your pocket, you walk away. You don't have to reinvest into something else. With 1031, as I mentioned earlier, it is an exchange. You do have a requirement to reinvest it into another piece of real estate.
Perfect. And I do have one more question for you.
Yeah.
My seller owns a rental purchased as a 1031 exchange. He has owned and rented out the property for approximately 20 years. He wants to sell and purchase another property as a 1031 exchange, rent out the new property, and eventually move into it.
Yeah.
The 2 questions that come from that are, how long must he rent before he can occupy it? And how long must he live in it to minimize his capital gains tax when he sells?
Well, yeah, that's a great question. Comes up all the time. There is no specific holding period for an exchange or a conversion of exchange to your primary residence. The requirement, though, is that you hold that property at least 5 years. Okay. But there's no requirement that says you have to rent it out for 3 and then move into it for the next 2 years. You could realistically rent it out for 6 months, move into it, and then as long as you hold it for 5+ years, you've satisfied the conversion. The problem is, once someone does that, so let's say this guy had owned the property for 20 years, he probably has a substantial amount of gain, right? More than $250,000 or more than $500,000. When he converts that, he's deferred that gain to new property. And let's say he rents it out for 3 years or 4 years, moves into it, lives in there another 3 or 4 years. So now it's year 8. Okay. So he deferred, let's just use big numbers. He deferred $1 million. And now he's owned that new property for 8 years, and he's got another $500,000 of gain. Okay. So he's got $1.5 million of gain, and he's a single person. Okay. He can deduct out his $250,000. That's it. The rest of it he's going to pay capital gains tax on. So it goes back almost to the previous slide, is you're not going to avoid it, right? You're not going to avoid defer. When people talk about converting their exchange property into the personal residence, it's almost like, okay, well, you need to that's your forever home at that point, right? Because the next trigger for a capital gains event would be the sale. And once you sell it, Uncle Sam's going to say, okay, John, I'm ready for you to pay me now. Doesn't matter if you've owned it for 1 year or 5 years or 15 years, the deferred gain is going to stick with you. So remember, there's no magical formula for how long you have to hold it for investment. I just tell people the longer, the better, right? If there's a minimum of 5 years for holding period, in my mind, it makes sense. I use logic. Now, again, logic doesn't enter into the IRS mindset here, but I use logic. And I say, you should probably rent it out for at least 3 years. You file 3 tax returns. You've probably, I'm using the wrong word, but you probably know what I mean. You've seasoned that property well enough to know that it has met now the smell test for investment. You now move into it years 4 and 5. Now you've covered both bases, right? You've held it for 5 years total, and you've lived in it for any 2 of the last 5. So at the end of year 5, theoretically, you could sell it and take your primary residence exclusion. Any additional gain, you'd pay a prorated amount of that to Uncle Sam. So, again, we see that a lot with people planning for retirement, which is totally fine. But remember, an exchange is not tax avoidance. right? Exchange is tax deferral or not tax-free by any stretch. Keep going and you're good to go, right? Exchange, 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 then die.
Cool. And then we'll do one more. We'll try to limit it to 3 per round.
Yeah, but, no, totally fine.
Last question, exchanging into new construction that will not be completed for 6 months after the sale of the property you're exchanging out of.
Yeah. Bottom line is that doesn't work, right? Because you have to, the maximum life of an exchange is 180 calendar days from close of escrow of the relinquished to close of escrow on the replacement property. If the builder's not going to be able to deliver that product to you, and if you're working with a traditional, let's say, mainstream builder, they're going to need a C of O for that in order for you to close that escrow. You're not going to be able to close the escrow. It's not going to qualify for 1031. Now, if you've got, Joe Contractor building a spec home for you, and he's okay to transfer the ownership to you through some escrow, but maybe the project is 80% complete, then that would work, but not if they're not willing to transfer title. In order for an exchange to work, you've got to relinquish title on the property you're selling and acquire title on the property you're buying. The property doesn't have to be complete, but the value does have to be equal or greater to what you're selling. Does that make sense?
Makes sense to me. We have one more. Do you want to wait, or do you want to tackle
that? Let's go for it. Yep.
My client has about $2 million in gains and she lives in it. She is thinking of renting her personal home until she can do a 1031 on something else.
Yeah.
Rent or buy during this time. How long does she need to rent her primary residence until it's considered an investment property? And I think you said 3 years, but would like to confirm.
Well, yeah, no, it's not 3 years, right? Okay, so, and we're going to get to it here. We're going to sum up 1031s in a single word, and that word is intent. But so the intent has to be the property's held for investment purposes. And there's specifically not a number of years or a specific holding period for 1031 property, because they don't want to go, well, as long as you hold it for 2 years or 3 years or 5 years, then automatically it covers an exchange. It's always about intent. So if someone, again, is trying to take and we see this a lot too, and these are great questions. I probably should have started off by saying, first off and foremost, I'm not a CPA. I'm not a tax attorney. So just like you guys, we give information out to customers and we say, you definitely should speak or consult with your tax person when entering into these types of transactions. For this one, it's a great question. We see it all the time. I would tell the customer, talk to your CPA, but probably at least 2 to 3 years is a good amount of time to convert that property into an investment. Could they do it next year? Sure. I mean, everybody loves December 31st, right? That's the magical deadline for so many people. So if you have a property that crosses over a tax year and, we've been reporting it as investment for 2021, now it's, 2022, now it's 2023, we're going to sell the property and do a 1031, great. I mean, if that is okay, you've got a great exchange until you get audited, right? You're sitting in front of an auditor and the auditor's going to go, hey, Sally, tell me about this property that you've owned for 20 years, converted it, held it for investment for 6 months, and now you're doing a 1031 exchange. Does that work? Don't know, right? Why did you sell it after 6 months? Oh, well, what happened was I got relocated. Oh, the market shifted. Oh, my tenant left me. I decided to chase a better investment. I mean, facts and circumstances will dictate every transaction, but there's not a bright line test for how long you have to hold the property before you convert it. Additionally, remember now, let's say they did hold it for 2 years and their CPA says, yeah, that's a good holding period. Now they're going to sell for $2 million. They got to buy for something for $2 million or more as well, too. They can take their personal residence exclusion because that's any 2 of the last 5 years. So again, if they sell for $2 million, it's a married couple, they can net out their $500,000 and do an exchange for $1.5 million. Make sense?
Yep.
Okay.
I think you're all caught up. So
yeah, great. Well, let's go back to the last slide because this is actually the most important slide on my whole presentation. I'm not overstating everyone on the call. If you remember anything about today, remember this slide. It's the most important component of the exchange. It's all you need to know. People love to make 1031s complicated, and they're not. They're not complicated. We deal with 2 requirements for an exchange, value and equity. Both of those numbers are very easy for us to determine or view or see. We know what the value is. That's what they're selling the property for. Sales price, contract price, purchase price, whatever you want to call it, it's the value. What's the property being sold for? I'm selling for 1.3 million. I got to buy for $1.3 million or more if I want to be fully tax deferred. If I net $750,000 from my sale, the $750,000 is the minimum amount that needs to go into the replacement property. Believe it or not, nothing else matters. I don't care how much your debt is. I don't care what you paid for it. I don't care how much improvements you put into it. I don't care how much it costs to get it ready for sale. None of that is applicable for an exchange. When you're looking at 1031 transactions, I would say you're at the proverbial fork in the road, okay? I'm going this way to do a 1031. I've got to replace value and equity of what I'm selling. Equal or greater value, equal or greater equity. I'm going this way, I'm not doing an exchange. Now I consult with my CPA about my gain, my basis, how much improvements I've put into the property, how much depreciation I've taken, how long I've owned it. All those other factors go into if you're not doing an exchange. If you're doing an exchange, I sold for $1.5 million, I got to buy for $1.5 million or more. If I net $1.2 million, the $1.2 million is my minimum amount to put into the new property. The difference between the value and the equity on the replacement side, you can make up any way you want to. And people are going to go, I thought you had to have equal or greater debt. You don't have to, as long as you offset the debt relief with your own money. Okay. So again, let's go back to that example I just stated. You sell something for $1.5 million, you net $1.2 million after you pay off your debt and your expenses. Okay. The replacement property you're buying is $1.6 million. You've traded up in value. You've got $1.2 million in your exchange account, and you're going to put in $400,000 of your own money. Are you fully tax deferred? Yes. Where people get into trouble is they buy the property for $1.6 million, they get a loan for $1 million and put down $600,000, and they've got money left in their exchange account, and that's boot, and that's taxable. You can't over leverage yourself. You can offset debt with your own cash, but you can't go the other way around and offset cash with more debt. So equal or greater value, equal or greater equity. That's the simple requirement in order to be fully tax deferred. Okay, next slide, Brianna. So if you're not going to do that, then you have boot. And that's basically the difference between what you sell and what you buy. And boot doesn't destroy the exchange. Boot is just taxable up to the amount of money you take out of the transaction. I see we have a couple questions too. You're on mute there, John.
Sorry about that. Get back to it. I don't think I was clear with my previous questions. This is from one of the earlier questions. I currently have an investment property and I don't own a personal residence. I rent. I would like to sell the investment property and exchange it into a fourplex. I would rent out 3 of the units and use the 4th unit for my personal residence. Would that qualify for 1031 exchange?
Yeah, okay. Go back to the previous slide real quick, Brianna. Yes, it does work as long as what? You've satisfied your exchange. So if you sold something equal or greater in value and acquired something, then you're fine. So again, the property you sold, let's say it was $1 million. Okay. Now you've got to acquire a fourplex where 3 of the units are equal or greater to $1 million. The 4th one is the one you're going to occupy. That's not going to be part of the exchange calculation. Make sense? So, you're now looking for something for, let's say, $1.4 million, where 3 of the units are valued at $1 million. The 4th unit's $400,000. You're going to live in that one, but your exchange, you met equal or greater, the requirement of equal or greater value to what you're selling.
Cool.
Does that work?
Next one, is there a reverse exchange?
Oh yeah, that's a whole nother hour seminar. We'll do that tomorrow. Yeah, no, there is, and we'll touch on them. Yeah, we'll touch on them real briefly at the end here. But yes, for sure. Okay. So boot is basically the leftover of an exchange. And again, many people take boot out totally fine. They want to say, I need $100,000 for this, that, or the other. I want to put money in my pocket, money under my mattress. I'm going to buy my kids a new, Ferrari, whatever. No problem. They're just going to be taxing the amount of boot they take out of the transaction. Totally fine.
Cool. Last question I think we have here for now. I have a primary residential and 1 1030 exchange. I move into a 1030 exchange property in my primary residential to rent. Is it possible?
Okay. I didn't understand that one.
Okay. I have a primary, I have a primary residence and 1 1031 exchange. I move into a 1031 exchange property and my primary residence to rent. It is possible.
Well, yeah, but there's no exchange though. You're not selling anything, right? You're just moving from your current primary residence to move into your rental property, and then you're going to rent out your primary residence.
Sure.
Yeah, there's no trigger for a taxable event at that point. You haven't sold anything.
Sure. Makes sense to me, Mark. If we answered that correctly, great. If not, just shoot another note in there. We'll get it.
Yeah, hopefully that helped. Okay, we can go to the next slide, Brianna. So when we talk about boot, we've got 2 types of boot, really actually 3, but mortgage boot and seller finance are kind of the same. Cash boot is very easy for us to see, right? It's the amount of exchange funds that are left over from the exchange account. So again, You sold $1 million property, you netted, 900,000. You bought a new property, you only needed 875,000 bucks for the new property because you got a loan, and now you've got a couple bucks left over. The $25,000 is cash boot. You'll pay tax on the cash on the $25,000. We'll send the FTB withholding to the state of California, just like you would. We become the withholding agent in an exchange, and the rest of the exchange is tax deferred, no problem. Mortgage boot comes in when we have generally when we have a trade down in value. Mortgage boot happens when you don't replace your mortgage, but you don't trade up in value. Okay. So again, I've got a property that's $1 million I'm selling. It's got 500 of debt, 500 of equity. I'll buy a new property for $900,000. Okay. I've traded down in value. So already we know we're going to have boot, but I put $500,000 of equity from my exchange. I just get a loan for $400,000. That difference between the mortgage relief of the relinquished property, the 500, and the new mortgage, 400,000, that's the mortgage boot. And you'll end up paying tax on that 100,000 bucks. Again, generally speaking, not always, but generally, investors are looking to buy up, right? If an investor is selling a property for $1 million bucks, he's generally going to look for something $1.1 million, $1.2 million, even $1.3 million, or he's going to buy two properties at $600,000 each. He's trying to stretch his investment dollars. So again, a general statement, investors, don't always have a lot of boot or take a lot of boot. Some do, but most investors are looking to exchange up or equal in value to what they're selling. The last one is seller financing. When we're doing a carryback and the seller wants to do an exchange, it's not a good fit. Why? Because now you've limited your exchange by the amount of the carryback, or you've reduced the amount of the exchange by the amount of the carryback. So let's say, again, you're selling a property that's $1 million bucks. The buyer's coming in and says, hey, Brianna, I need you to loan me the $800,000. I'll put $200,000 in cash. And Brianna's like, well, I want to do a 1031 exchange. All you're going to have for your exchange is the $200,000 bucks. You're going to be short because you just did a seller carryback for the $800,000 bucks. So seller carryback and a 1031 aren't always great. The easy fix for that is the easy fix is tell them you have to find another source for their loan, or you have to be able to convert the note into cash before you buy your replacement property. So Brianna's got $800,000 in her personal account. She actually literally will wire that money into your escrow. You'll close the escrow. The note and deed of trust gets made in favor of Brianna, the seller, but her $1 million comes to the exchange account. Now she can do a fully tax deferred exchange. So that's the only time that's going to work. And again, we don't really see that a lot. We're starting to see a little bit more seller finance deals. Rates have ticked up a little bit, of course, as you guys know. So we're starting to see a little bit more creativity out there. But if they're trying to do a 1031 and a carryback, it's not always a great fit. Okay, you can go to the next slide. So as I said a minute ago, 1031 gets whittled down to a single word. How do you define an exchange? You define it with this word here, intent. The property must be held for productive use in a trade or business or held for investment. That's a lot of fancy words that says, I don't know what. Okay. When we talk about residential transactions, we talk about investment property. Generally, I hate to say this, but generally we talk about property that's investment, that would be income property. Okay. Doesn't have to be nothing. This is taken right out of the 1031 code. Nothing here says it has to produce income, nothing, right? So I think I saw something in the chat about raw land. Raw land qualifies for 1031. No income production on raw land. So that's held for investment. California, Southern California, the beach cities, right? We see a lot of what I call speculators, people that buy property just on appreciation. They have no intent to put a tenant in the property, have someone sign a lease, use Airbnb or VRBO, none of those. They simply buy property and they sit on it because they know in the next 3 to 5 years it's going to go up in value. Does that work for 1031? You bet. Their intent is to hold it for investment. So, and then property used in a productive trade or business would be, let's talk about, commercial transactions, owner users, investors that own warehouse, retail, office, all the other properties, no problem. The caveat is personal use. When you start using a property for your personal use, that's when you've now kind of grayed out or kind of clouded the 1031 opportunity. So properties can't be held for personal use. You can't have a vacation home or second home that's your personal vacation home or your personal second home. That doesn't work. So again, you have a property that you own in Mammoth and you go skiing there every year. The rest of the time it sits vacant. That's not going to work for 1031. You have a home on the East Coast where you go there during the summer and you're here on the West Coast in the winter. and nothing else during those times, that's not going to work for 1031 either. Property held for investment's got to be something that is just that, holding for investment. So your personal use property, I tell people exclude. Other things that are excluded are property held for sale. And I put flipping down. I mean, that's where we see people flipping property. They buy it, they fix it up, they put it back on the market for a quick buck. Not going to be an exchange opportunity for them either. And I'll give an example to define intent, because now again, I'll give you an example. We never define intent for a customer. We never would I tell a customer, yes, this is going to work. No, this is not going to work. I would say, here's your potential pitfalls. Make sure you're consulting your CPA, right? At the end of the day, I don't sign their tax return. We don't even report anything, right? On an exchange, nothing gets reported to IRS or Franchise Tax Board unless they have withholding. That's it. They are the ones who file the 8824 form, which is the like-kind exchange form, when they submit their tax return at the end of the year. We don't file anything with anybody for a 1031. So when we talk about intent, here's my example I always give. Guy buys a property, let's say he buys it, it's a foreclosure, it's a total knockdown. He takes it down to the studs and he's going to redo that property, but he's going to flip it, right? The redo is going to take him 19 months, right? Almost 2 years he's held the property, but on month 20, he's done. He's got a for sale sign in the front yard. He's got it listed with a real estate agent. Can he do an exchange? Yeah, maybe. Did he find intent to hold for investment? Not really. He bought it with intent to sell, right? He's done this 17 other times in the last 6 years, right? He's a real estate investor who flips property. That's what he does. So can he do an exchange? I would tell him, make sure your CPA is in the loop on that and in the know and have them make that determination. I would say based on your intent, probably not. Different guy buys a piece of property, means minimal work, right? New carpet, new paint, maybe some new landscaping. Month 2, he's got a for rent sign on the front yard. And month 3, he signs a tenant to a 2-year lease. Guy moves in, and now 3 months later, he gets the neighbor, comes to him and calls him and says, hey, Joe, I want to buy your property. It's an unsolicited offer. You didn't have it with a real estate agent. He's got it just not on the market, nothing. He just gets an offer from the guy that lives next door. He wants to buy the house next to him. And he sells it at month 7, makes $100,000. Can he do an exchange? Yeah, you bet. He's clearly defined his intent to hold that property for investment. So again, not that we want to help them make that determination, but those are the kind of the parameters that we look at when we have people defining their intent to do an exchange. It's never about timing. It's always about intent. So that doesn't matter if they've held the property for a year or 10 years or 20 years. Their intent is, what are they doing with that property during the time of ownership? And then, of course, you cannot exchange stocks, bonds, notes, partnership interests, and even personal property can't be exchanged anymore. I'll pause there to see if we have any questions.
Yeah, we have some that kind of align with what you're talking about. So does a seller have to prove a property is an investment, such as Schedule E, to reflect the reporting of the investment income?
No, not at all.
And that's essentially because they don't have to be making income off of it, correct?
That's right. Nothing in the code there says anything about production of income. Yeah, held for investment. So it's a broad term, but I always tell people, look, 95 out of 100 times, we know what they're doing, right? It's those 5% of the time where people are like, they're running with scissors, as I like to say, right? They're kind of trying to, I don't want to say pull a fast one, but they're not your cookie cutter exchanger. So in those scenarios, John, I just tell people, we're not the exchange police, right? We don't report anything. We just want to make sure you're following the requirements of the exchange, adhering to the 45 and the 180, making sure your documentation is in place. But again, at the end of the day, you've got a good exchange until you get audited. Here's the good news. There's a good news, bad news scenario. Good news is IRS not auditing 1031s as a matter of practice. We don't see a lot of IRS audits on a federal level. Bad news, Franchise Tax Board, you bet. They have yet to meet a transaction they didn't want to audit. So when we look at 1031s on a local level, especially someone that's selling a property, again, let's say $4 or $5 million or more, I was just telling them, plan on an audit. Plan on it. You might not get it, but you should plan for it.
Cool. Quick one here. Can a corporation do a 1031 exchange?
Oh, yeah. And I should have mentioned that earlier. So good question. Any entity or anybody can do an exchange. So I always use the example, Joe Smith can do an exchange. Joe and Mary Smith, husband and wife, can do an exchange. The Smith Family Trust can do an exchange. The Smith Irrevocable Trust, Smith Holdings, LLC, the Smith Corp or Smith Partnership, Smith Partnership. So any entity can exchange. If you're all titled to real estate, you can do an exchange. The only caveat there is we've got to keep we should keep the vesting consistent, but more importantly, we need to keep the taxpayer consistent. So if we have a scenario where we've got Joe and Mary Smith, trustees of the Smith Family Trust on the relinquished property, they're buying a replacement property and they're financing it, the lender says, we don't really want to loan to your trust, we'd rather loan to you as a husband and wife, totally fine. The vesting's different, but the exchanger, the taxpayer is the same.
Then we have an addition to the earlier question about proving an investment. It says, if no proof, why would a seller not claim a second home as an investment? Where would this matter? During an IRS audit only, or would a lender require some proof of something?
I think if they got audited, yeah. So again, for me, I'm not a risk taker. It's their risk. It's not mine. If they want to do that, I'm not going to stop them. You know what I mean? Like, again, when I take calls all day long about 1031. Literally, one of the first questions is someone says, I want to do an exchange. I said, oh, so the property you're selling is held for investment. They just say, yes, great, I'm moving on. Right. I don't police the transaction, and we try to provide customer service, but by no means am I going to dissect that. Whoever asked that question, you're right. We're not going to question whether or not they held it for investment. And plenty of people will do that on their second home and their vacation home. Not for me to stop them. They get audited, they're going to have to explain it to an auditor.
Sure.
Yeah.
And then we have a scenario here. So if I sell a single family residence rental, so one unit for $750,000 in California, then I went to buy out of state where the prices are less, would I be able to purchase multiple properties, say quadplexes, and be able to do 1031 exchange?
Oh, absolutely.
Would the total of the properties purchased have to be equal or greater than the $750,000 selling price for a property in California?
You bet. Yeah, that's right. Yep. So mixing and matching property types, no problem. Out of state, no problem. It's value for value, equity for equity. So the combined value of what you bought, it's got to be equal or more to the property that you sold.
Cool.
Great question. Yeah.
And then we got a couple popping up. Do you want to take the questions now?
Yeah, go for it. Yeah, for sure.
I'm thinking about living in the casita of our investment property for a short period while possibly turning the main 3-bedroom, 3-bath house into an Airbnb. Will it still be available for a 1031 if sold a few years later? The house has currently been rented for over 10 years.
Yeah, I mean, I think that kind of falls into that same category with the fourplex, where it's like mixed use property. So, again, I tell people, I don't see any issue with that at all. I would work with your CPA to make a reasonable calculation when you sell that property, how much of the value goes to the 3-bedroom house, how much of it goes to the casita, right? And if you want to exclude the casita, take the personal residence exclusion, assuming it meets that smell test. It's got a kitchen, and it's a residence. It's not just a bedroom, if you will. I think that would be kind of one of the underlying factors to that, but I don't see any problem with that at all.
Well, and I would think that it's been rented for 10 years shows it's an investment too, right?
Should be fine. Yep.
Okay.
I don't see any issue with that.
One more. My corporation owns a summer home. I live in it for the summer and it's vacation the rest of the year. Would that fly?
Yeah, I mean, the rule of thumb for a vacation home is you can occupy for 14 days or less out of the year. Okay. Now, again, they have the added little wrinkle here that his corporation or her corporation owns the property. And they, depending on what their relationship is to the corporation, if they're the sole shareholder, if they're the majority shareholder, that might be problematic. But yeah, I mean, I think that would probably fall into their second home, their vacation home category, that I would not tell them, oh, no problem, you're good to do an exchange. I would simply tell them, really should check with your tax advisor. You're occupying it for more than 14 days or more out of the year. It doesn't really meet the exact smell test for 1031. And that's why these are all great questions. And all of them, many of them fall in that category where it's not the norm for your exchange. I mean, again, when we do an exchange, the majority, 95 out of 100 are out there selling a rental property, they're buying another rental property. These are these 5%ers that come in that have all these, kind of weird questions or weird nuances to them that we don't hear every day. So keep asking them because they're good questions to get feedback on.
We got another corporation question for you. So Can my corporation do an exchange and then I personally rent my home from the corporation?
Yeah. I mean, again, that's again, we get that a lot too. I don't see why not. Again, you just got to be careful that you create an actual lease, right? That you're paying somewhere close to fair market value for the property, that you can see money changing hands, right? You're cutting a check to the court. I mean, it's got to be a true lease. It's got to be a true agreement that's in place. If you're, the other one is, can I buy a replacement property and rent it out to my kids? Okay, sure, you can. But if your kids are paying a nickel for a penthouse in Manhattan, does that really, are you really charging them fair market value for that? So when it gets a little familiar, with family and related parties, you just want to make sure you've got I's dotted and T's crossed and you've got documentation in place. No, there's no, magical formula for that. It's, what do I say? It goes back to the word intent. What is your intent? Is it to be held for investment, or is it to provide some personal, benefit for your family member? I mean, it's a little bit of a shifty politician's answer, but there's not a bright line test that says yes or no for that.
Cool. Well, that's all we have for now.
Okay. So we've already kind of discussed the personal residence solution. Remember, you own the property, you've lived in it for any 2 of the last 5 years, doesn't have to be consecutive. You can deduct $250,000 a gain if you're single, or $500 if you're married. So we talk about an exchange. We've talked about this a little bit as well too, the like-kind requirement. If you've been in the business any long period of time, you remember back in the good old days, 1031s had a like-kind requirement that said, if I sold a single family, I had to buy a single family. If I sold commercial, I had to buy commercial. It was a like for like scenario. Now, again, I'm dating myself. This goes back to the early 90s, late 80s. Now it's all changed. Now it's any investment for any other investment. Mixing and matching property types, totally fine. I can sell my single family. I can go buy an apartment building. I can go buy retail. I can go buy raw land. I sell an apartment. I can go buy an office building. I can go buy commercial property. Doesn't matter. Real estate for real estate. That's the requirement for 1031. Okay, next slide. Okay, so here's what people look at when they sell a property. And it's a crude illustration, but basically it says, if I sell a property for $800,000 that I originally bought for $100,000, I'm going to have $700,000 of gain. Based on today's current rates, I'm going to pay about over $250,000 of tax if I sell the property. 250 grand. Now, let's say, I always throw this in as the last piece of it. Let's say they have that property, and let's say they refinanced it last year. They put a mortgage on the property for $750,000. So now they end up netting less than $50,000. They're still going to have tax due of $259,000. They got to dig into their bank account to pay that tax if they sell the property. Remember, gain and basis have no relationship or correlation to equity and debt. Okay, next slide. This is now the nuts and bolts of the exchange, the kind of the timeframes that were associated with 1031, the identification requirements, and this is kind of the nitty gritty of the process. You're gonna have to click through a couple of times there, Graham. Keep going. One more, I think. Yeah, okay. So the maximum life of a 1031 transaction, start to finish, 180 calendar days. Day one was yesterday. You closed your escrow yesterday. That's day 0. Today is day 1. You've got 180 days to close escrow on the replacement property, right? They can't just be under contract or in escrow. They have to close the escrow. So good news is that's relatively easy to do. Even in today's environment, most people can find a property, get it closed within 6 months, roughly 6 months, specifically 180 days. If their 180th falls on a Saturday or a Sunday or a Monday holiday, they're going to lose days. They're not going to be able to go to the next business day. They got to close on the previous Friday. Okay, so remember, we got to close the escrow on both sides. The clock starts ticking when I close the relinquished escrow, and the clock ends. It's got to end, or you got to close escrow before the 180th day on the replacement side. The tough part of an exchange is the 45-day identification period. The first 45 days of the 180, they have to identify the replacement property. No exceptions. After day 45, you have zero ability to amend, restate, resend, whatever your identification. It's due on day 45, and the properties you submitted, they're going to be set in stone. So for identification purposes, there are technically 3 rules. Realistically, there are 2. The third rule I don't even discuss. I've literally seen it work one time successfully in my 25 years of doing 1031. So most people use the 3 property rule. The 3 property rule is, of course, the easiest of the 3 rules to manipulate because it limits you to 3 properties. But that's the only requirement. I can list 3 and no more than 3. Any 3, regardless of value. Okay. So if I sell $1 million property, what's my rule? I got to buy equal or greater in value, equal or greater equity of what I'm selling. I can identify a property that's $1.1 million. I can identify another property that's $5 million, and I can identify a third property that's $65 million. And of those 3, I'm going to acquire 1 of them, 2 of them, or all 3 of them. Okay. I don't have to acquire everything I identify. Okay. And we see this rule used, let's say 75% of the time. Okay. The other rule is a rule that's used more so when people are diversifying and they're going to sell one large property and potentially buy a bunch of smaller properties. And that's the 200% of value rule. The 200% of value rule says they can identify more than 3, but the cumulative value, aggregate value of everything they identify cannot exceed more than 200% of the relinquished property. I sell a property for $1 million. If I use the 200% rule, I can identify up to $2 million of replacement property, 200% of what I've sold. It could be 10 properties. They're all what, $100,000 each or $200,000 each. I can identify that, great. And of those properties I identify, I can acquire any number of them. I, again, do not have to acquire everything I identify. So if I identify 6 properties, I only want to buy 3 of them, great. As long as I met my exchange requirement, equal or greater value, equal or greater equity, I'm fully tax deferred. Next slide. Okay, so in order for you to identify property, we're going to provide the form to the client, just like we do all the exchange documents. They've got to have the form to us in writing. They have to describe the property, right? They can't say I'm buying the pink house on Main Street. They've got to have a physical address, a lot and track, a legal description, APN, something like that. If they're identifying a condo, they've got to have the unit number down as well too. So it has to be very, very specifically described. The form has to be signed by them. They can't just tap out an email in Outlook and send it to me. They can attach their identification form scanned in that they've signed and send it to me. And it has to be sent before midnight of the 45th day. When I say sent, meaning they send it. I don't have to receive it. If their 45th day is on a Sunday, I don't work Sundays. So as long as they send it out on their Outlook or their fax machine, I don't know if they're still using a fax, no problem, right? As long as it gets sent before midnight of the 45th day, it satisfies the exchange requirement. And of course, they can revoke their identification within the 45-day deadline. But I tell people, don't send me your list on day 5 and then revoke it and then send it to me on day 20 and revoke that again. Simply give me your list on day 45. Let me see if anybody's got questions on identification.
Yeah, we got 2 down here. My client has a commercial building to sell. Can he exchange 2 residential properties?
Yeah, you bet. Mixing and matching, totally fine.
And then what are some alternatives to doing a 1031? Real estate investment trust, I think, if I'm not sure that acronym right.
Yeah, REIT.
Yep.
Yeah. So really a REIT doesn't work, right? Because a REIT is not an interest, you're not acquiring an interest in real property. Generally with a REIT, you're buying shares of a corporation. REITs are generally publicly held and they're traded on a stock exchange. What you could look at, though, in the popular product today are DSTs, Delaware Statutory Trust. We see a lot of people, kind of gravitating toward that replacement property option. The other one that's less used now because they had such a tough time in the early to mid 2000s is TICs, tenant in common structure. The kind of repackaged TIC is now a DST. A DST is fractional ownership, where you're buying a small percentage of a very large property and you're one of 100 or 200 owners. And you're getting basically a rate of return on your money. So, but in terms of what other options there are, that's it. It's real estate for real estate. So DSTs are really kind of the only thing that you could acquire that wouldn't be like a standalone piece of property.
You're all caught up.
Okay, so we already talked about the same taxpayer requirement or vesting consistency. Ideally, you want the vesting to be the same, right? ABC partnership is the seller, ABC partnership has to be the buyer. ABC partnership is a separate standalone tax entity, has its own tax ID number, files its own separate tax return. It's an exchanger. It's going to do the exchange and sell a building, and it's going to buy the new property in the same manner. Totally fine. Ed Mills, he's an individual. He can exchange in and out of properties, no problem. The Smith Irrevocable Trust. An irrevocable trust is a taxpaying entity. It's got its own EIN number, or tax ID number, I should say. It's going to sell an asset. It's going to buy an asset. A lot of times we see family trusts that can convert it into irrevocable trust and they stay intact and they keep doing exchanges and they keep owning property going forward. Totally fine. Teresa, she owns 100% of her property. She now is going to go buy a property. Instead of buying 100% of something, she's going to buy a TIC interest in something, or she's going to buy a DST. Those are totally fine as well too. We talked about the trust to husband and wife conversion, totally fine. What we can also see is a husband and wife or an individual or even a partnership or an LLC form a new single member disregarded entity as on the replacement property. So Tom and Mary Jones are husband and wife here in California. We're in a community property state. They can be the sole member of Tom and Mary Jones Holdings, LLC. Different vesting, same taxpayer. The entity that they formed is disregarded for all purposes other than federal tax. The entity that describes who the taxpayer is Tom or Mary's Social Security number. Okay, we can go to the next slide. So here's some of the things to watch for. We talk about an exchange, and now this is where you guys get more intimately involved with documentation and how you guys structure 1031. It starts with a real estate agent or broker. We want to make sure that they put some type of 1031 intent clause in their contract. There is some type of an addendum to the PSA that says, the seller reserves the right to effect an exchange at no cost to the buyer. I tell the real estate community and everybody, avoid using words like cooperate and participate, because it's not a requirement for the non-exchanging party to cooperate or participate with 1031. They have to be notified. So I always use something more generic that says on the relinquish side, seller reserves the right to effect a 1031 at no cost or delay to the buyer. Simple. Buyer gets notified of that with the addendum. We're going to do our exchange agreement. They're going to get a copy of that as well too. We have an acknowledgement page where they are supposed to acknowledge receipt of the assignment. Good, we're good to go. What makes this an exchange is that we now get assigned into your escrow as the QI. We're the qualified intermediary. Before me, it's a sale. And before me, John Curry's selling a property. The funds are earmarked for John at the time you close, right? Now John has constructive receipt of the funds. Can you do an exchange once he has constructive receipt? Nope, he can't. 1031 says the taxpayer specifically cannot have any constructive receipt of the funds. What do? We basically provide an assignment document that assigns into your escrow that says, at the close of your escrow, you wire the money to First American Exchange or whoever the QI is, and we take possession of the funds. So you've got to have this interim layer in your escrow in the documentation that says, John is no longer entitled to receive the funds. Now the funds come to me. And when people talk about setting up an exchange, I get calls all the time. Oh, shoot, we closed yesterday. We forgot to set up the exchange. Can I do that now? Escrow hasn't dispersed the funds to me. I tell people, look, once you have constructive receipt, I'm not a receipt. Constructive receipt means control or direction of the funds. Doesn't matter if you closed yesterday, who's entitled to receive the funds? John Curry, he's your seller. You have no substituted qualified intermediary in your escrow. You're going to have to return the funds to John. The opportunity for exchange gets lost. So in order to set up an exchange, we have to have it in place on or hopefully before the close of your escrow. So same with replacement property documentation, simple clause in the contract. If it's not there, should you do an amendment? Sure, you should do an amendment. Buyer reserves the right to effect an exchange at no cost to the seller, no problem. With regards to identification, I tell people the only person who can receive the identification is us, right? They could technically identify to the seller, right? But people love to go, oh, I'm going to send my identification to my real estate agent. I'm going to send it to my escrow agent. I'm going to send it to my CPA, my attorney. Okay, I mean, if you want to accept it, you can technically, because you would be a neutral third party, but I would just tell you don't. You should say, no, you need to forward it on to your qualified intermediary. Who can accept the QI would be, who can accept the ID would be the qualified intermediary. So for us, we're part of First American Title Company. We follow the letter of the law. We hear about, accommodating accommodators, people that are flexible with deadlines, dates, things like that. None of that flies here with us. We, again, follow how the regs read. We want to receive that identification on or before the 45th day. Simple as that. We don't give tax or legal advice, of course. We walk the fine line every single day, right? We provide as much information as we can. We tell the taxpayer they need to make their own determination how they want to move forward. But for us, we're really here to process and facilitate their transaction. Okay, last slide. So as I said kind of at the beginning, and we're right at time, which is good. Exchange companies, I guess the first thing you should know is they are completely unregulated. Zero restrictions to being a qualified intermediary, none. And I always tell people, it seems to me it's very ironic since we're upholding a tax provision within the Treasury regulations, right? We're monitored by nobody. So anybody can open up their shop tomorrow and say, I'm doing 1031 exchange transactions. You're in business, great. What we bring to the table is, as I said, we've got a huge asset, First American Title Insurance Company. protects our funds. They issue a written guarantee that says every exchange that we do, the principal balance is backed up by the faith and the strength of the title company. We set up a separate segregated bank account for each 1031 exchange transaction. They earn interest on the funds, and we just collect a flat fee. Gone are the days where the exchange companies used to be able to participate in the growth factor. I don't know if anybody on the call remembers Land America, but Land America had some trouble back in 2008 with the mismanagement of some exchange dollars in the amount of $500 million. And they ended up unfortunately filing for bankruptcy, which made their title company file for bankruptcy as well too. So Land America is no longer. Some of their subsidiary entities got transferred off, like Continental Lawyers, things like that. But for us, we don't invest the funds. We put them in the bank. They get a passbook rate, right? A savings rate on their funds. Right now, the rate's literally like 0.01%. They're getting 1 basis point on their money. I think it was November, December, January, the banks were paying 0, right? So right now it's not about the interest, but it is about the principal. And the principal is backed up by First American. So if you want to do a Google search for exchange companies and fraud, you're going to get a huge list of companies that have just literally skipped town with the money. And in those scenarios, even the Land America scenario, the exchanger, the client is, number one, they're out their investment, they've lost their money. Number two, they have a failed 1031 because there's no money left to buy the replacement property. I always hear the number of 1,455. So I think Land America had 1,455 active transactions that all ended up failing. People had to pay capital gains tax on the loss. And, you know, we talk about, oh, well, so-and-so's got an E&O bond, and so-and-so's got a fidelity bond. Great. But let me ask you a question. Do you think that fidelity bond is going to pay off within your 180-day window for an exchange? No. Land America, I heard they settled with some people. They got a nickel on the dollar 9 years later. So forget about a fidelity bond and insurance bond. That's the only thing a small independent company can offer, other than maybe flexibility with their dates, which is that accommodating accommodator. For me, I offer the safety and security. I always tell people, you're getting safety, security, you're giving up freedom and flexibility. So how do you want to proceed using your exchange? I try to be upfront with people about that, because unfortunately there are some tough players out there in the industry that, use that to their advantage, that they're unregulated, and they attract business by, being flexible with their deadlines. For us, we don't do that. Obviously, we are part of the title insurance company. It's highly regulated. We've got Big Brother constantly looking over our shoulder. So we want to make sure we're dotting I's and crossing T's. Someone asked earlier about a reverse exchange. I mean, we are full service. We do reverse exchanges. We do construction exchanges. A reverse exchange, kind of simply put, is you buy the replacement property first, and then you have 180 days from that point forward to sell your relinquished property. But in a reverse exchange, we have to acquire title to the property. In a reverse, remember, you can't own both properties at the same time. You can't own the relinquished and the replacement together. You have to sell the relinquished and then buy the replacement thereafter. So I call a reverse a parking exchange. You're going to loan me the money, and I'm going to park title to your property. First American actually goes on the deed. We are the buyer of that property. We hold on to it until they sell their relinquished property. So I've got as much information as you could ask for on reverse exchanges. The best thing to do always would be to send me an email. Say, Anthony, send me some info. I've got a client that's interested in a delayed exchange, a reverse exchange, a construction exchange. No problem. We're happy to interface with your client directly. We provide, we can consult with them. We can set up a conference call. Whatever you feel is important or necessary, that's what we want to do. We want to be the resource for you guys for any 1031 questions you might have going forward. John, you're on mute, by the way. I don't know if you have more questions.
Yep, I got one question for you. If you have my 1031 exchange funds and your company goes out of business, what kind of recourse and or protection do I have?
Well, yeah, I mean, you have the guarantee from First American Title Insurance Company that the funds are protected. If the title company goes down, we're all in big trouble anyway. I mean, but all joking aside, the difference between us and like the way Land America had their bank account structured, they commingled the funds. They had one bank account. We set up separate bank accounts for each exchange transaction. It's a segregated bank account set up under the client's tax ID number, their social security number, however it may be. So First American carries enough in reserves to cover any and all deposits that the exchange company is holding. And just to give you a number, the exchange company is holding $4+ billion, billion with a B. It's big numbers that we're holding. We take the safety and security of the exchange funds very, very seriously. That's really one of the differentiating factors between us and name your independent exchange company, right? I mean, great. And I'm not bad-mouthing anybody, because I know, You got Exchange Resources, and you got what are those? Some I can't even think of them, but some of the other bigger independent guys, their fees might be lower. But look, don't chase after the low price guy for an exchange. I tell the customer, you don't want the guy who's the cheapest in town. You want the guy that's going to give you the most for your money. I'm more, right? But I'm not that much more. On a transaction where it's $1 million or less of the relinquished property, of what's being sold, $1 million or less, I'm at $1,000. $1 million or more, and I'm at $1,500. We're not breaking the bank for anybody. Okay, so people go, oh my, what's your fee? I go, what are you selling the property for? We're selling for $3.5 million. Our fee's $1,500. $1,500, oh my gosh, like so-and-so, I got quoted hundreds less. Okay, but that's an independent company. They're sitting behind their desk in their house. They don't have a $6 billion Fortune 100 New York Stock Exchange traded company backing your funds. So yes, I'm going to be more, but you're getting more. And you don't have to worry about an E&O bond or Fidelity bond, which we do have, to me is meaningless, right? It's meaningless because the asset protecting the money is First American.
Another question. Do you know if depreciation that you have taken over the years will be due when you exchange?
The depreciation moves over just like the capital gains tax. That recapture component just moves over. As long as you buy up from what you're selling, the depreciation gets deferred as well too.
Another good question. Would it be okay to share this recording with our clients doing the exchange, or is there content here that shouldn't be shared outside of professional agents?
No, I think you're fine to share the PowerPoint. I've sent it to John. So if you want to distribute that out, you definitely can share. I mean, I have probably better marketing material than a 16-page slide or whatever it is, a PowerPoint slide, but sure, I don't see why not.
And outside, just to clarify on my end, outside of the PowerPoint, would you be okay with them sharing this entire recording with their client?
Yeah, I mean, if your client's got the mental fortitude to want to sit through my droning on for an hour, sure.
As I say, as you said, you can always reach out to you and you're happy.
Yeah, I mean, yeah, fine. I appreciate everyone that's stuck with me here for the last hour, but yeah, for sure. I don't see why not.
And then another question you somewhat touched on, but just what are the exchange fees?
Yeah, I mean, it's $1,000 or $1,500. Well, okay, so it's $1,000 for $1 million or less. We always, I think if I sent you my fee flyer, would say we charge for additional replacement properties, but we generally don't. It's a flat fee. It's all inclusive. The relinquish and the replacement property both, or if they buy 2 replacement properties, it's still $1,000. From $1 million to $5 million, it's $1,500. Same thing, flat fee. Over $5 million, it's $2,000. If we're talking about a reverse exchange, definitely more. Residential reverses are around the $10,000 in the $10,000 ballpark. Non-residential, commercial, and up, they're $12,500 to $15,000. So definitely more money. But in a reverse exchange, we're setting up an entity, we're taking title to property, potentially signing loan documents, we're creating a net lease. We're definitely more involved in a reverse exchange than we are in a forward exchange. Remember, in a forward exchange, we're preparing documents and we're holding the money. That's our role. We're helping them navigate through the exchange deadline, the 45-day and the 180. But, again, our role is very limited in an exchange. So our fee, again, is, I think priced, accordingly. Now, again, I don't compete with anybody but maybe one other competitor out there. And they'll go nameless. You probably know what I'm talking about. But I don't compete with the small guy. You know what I mean? Again, they probably do great business and they do, a good job in the exchange, but they don't offer the same thing I offer. I offer a big, safe company behind me protecting the funds. And it may not be an issue, but when it becomes an issue, then it's an issue that they're going to have to deal with or settle with. And, for them to save $150 or $200, that's up to them.
No other questions. As of now, anything anybody else has they want to throw in here at the last minute? I think that's all we got, Anthony.
Awesome. Well, yeah, thank you, John and Brianna. Thanks for allowing me into the group here. And I know First American, and we have a, relationship with you guys and we want to keep that going and keep it strong. Utilize me as a resource for sure. We want to be, your resource. If you have questions about an exchange, I'm sure people on the call have worked with my team. We've got Robert Benavente, Kirsten Mack, Una Kim, Sydney Fan, Cecilia Pinedo. We've got a host of people that, work for my team here in Southern California. And yes, we can do transactions anywhere in the US. It doesn't have to be a California deal, a Southern California deal. If you've got a guy that's a client that's selling property out of state, we can still assist with that as well too. So please keep us in the loop on anything you have for with your exchange needs.
And I'll just end. Anthony's contact info is there on your screen. If you think of this 3 months down the road and you can't remember Anthony's name, reach out to Bree, Jer, or myself. We're happy to connect you. And as Bree mentioned earlier, The recording will be available. It usually takes us a day or two. So, but send us an email if you'd like a copy of it. If you have any other questions or anything else we can do to help you guys, just give us a call, send us an email, whatever works. We did have a question pop up, Anthony, if you have a minute. Oh, yeah. Just a thank you. So I'll pass that along.
Okay, great.
Thank you, Anthony.
Oh, my pleasure. Thanks, everyone. Have a great day.
You too. Thanks, Anthony.
Okay, you bet.
Yeah.